It's time to review the Sifter Fund's third quarter performance. This quarter marked the first negative quarter after 7 consecutive positive ones, with the fund's price dropping 6.7% between July and September. However, the year-to-date return stands at a respectable 10.2%. So, Olli, how would you comment on the last 5 years of the Sifter Fund performance?
Yeah, well, over the past 5 years, Sifter Fund has performed really well, better than many of the global equity indices. So from that perspective, what happened in the third quarter doesn't look as alarming as it otherwise would. But definitely we should look into the third quarter and show the investors what exactly happened there.
Yeah. Do you remember on which date the stock price decline started during the holiday season?
Yeah, around the middle of July, 15th, probably, yes.
Yeah, it was exactly 15th of July when the stock prices started to go down and especially the technology and semiconductor companies. And it was called as a flight to safety when the defensive stock started to be more attractive because maybe they were perceived as less risky. And this led also for the Sifter that the top performers of the third quarter were Northwest, which is a Canadian retail company, also TOMRA, Norwegian waste management company, and ADP, which is a kind of like a boring software company in the US. Those were the top performers. And on the flip side, then we have the decliners, which were mostly which companies?
Yeah, well, mostly semiconductor equipment manufacturers. So Disco Corporation was the worst. Second one was BE Semiconductors, and then there was Lam Research. But also our fourth equipment manufacturer, Applied Materials, was one of the big decliners.
Yeah. So could you comment on the main reasons for the Sifter Fund's underperformance during this third quarter? What was the main reason?
Yeah, well, the main single reason was indeed the underperformance of these semiconductor equipment manufacturers. And the key thing is there that it's just that we have a heavy weighing in those. So 16% of the portfolio on average over that period was invested in semiconductor equipment manufacturers. And that's a pretty significant weight considering that the global equity index has about between 1 and 2% weight in those. So, yeah.
It's a big difference.
It's a big difference, yeah. So yeah, the share prices of those underperformed, but, well, we don't see any significant change in the long-term perspective of those companies.
Well, that would be my next question.
Yeah.
How would you comment on the outlooks? Was there something dramatic in the outlooks or the results or the whole in the whole semiconductor sector?
Yeah, there were definitely a lot of news, but they mostly seem to create some short-term uncertainty or just generally kind of dent the general investor enthusiasm around those companies. So you could categorize them in 3 points. So one was that investors started to sort of question and doubt kind of the rate at which investments in artificial intelligence will grow in the near future. So those doubts emerged because investments made by cloud companies into AI, those investments are still significantly larger than the revenue that those companies generate from AI services. So yeah, that picture kind of concerned investors. But well, Microsoft, which is one of the key players in that field, has kind of offered some commentary on that. They expect the AI revenue to accelerate within the next 2 quarters or so when they get new capacity. So
it's a question of return on investments and the commercialization.
Yeah.
And you and I, we spent 1 week in Taiwan visiting the companies, the TSMC and the big names there. And what we learned that all the CEOs and the experts say that take it easy now. We are only investing now. Don't wait the commercialization too fast. Is that correct?
Yeah, that's essentially what they said. And yeah, it's pretty natural to first invest and then kind of generate revenue from the capacity that you have. So, but yeah, discussions around this topic were definitely one thing that kind of dented the sentiment.
What else we have?
The second thing was that U.S. Clearly plans to tighten its control over American technology, and the key motive there is that they want to prevent these highly sophisticated semiconductor manufacturing equipment from ending up in China. And well, these 4 companies that I mentioned, they generated about 1/3 of their revenue from China. So sure, over the short term, this could have a significant impact on them. But really, it's those restrictions don't really seem to impact the demand for semiconductors. So over the long term, it seems that there should be just as much demand for those equipment, but it just might be that they are not purchased from to be shipped to China. They might be shipped to some other country where the manufacturing
Europe or US.
Europe, US, or
other Asian countries.
Exactly.
Yeah.
But yeah, that was the second thing that kind of created
any other
uncertainty. Well, the third one was specifically Intel's difficulties. So yeah, their difficulties are kind of getting worse, and they cut investments for this year by about 20% from their original plan. And I'm sure that also does have some direct impact to those Sifter companies, because they do also sell directly to Intel. But on the positive side, those difficulties benefit Intel's main competitor, TSMC, which is also in the Sifter portfolio. So TSMC actually performed pretty well in the third quarter, better than the Sifter portfolio on average. So,
so how would you conclude based on these 3 different reasons? Are we more pessimistic now, or have we remained our outlook pretty much same?
Yeah, well, the short-term uncertainty has increased, and those points that I mentioned are more or less negative, but still the long-term picture seems pretty much intact. So we still feel, we still see that the semiconductor industry is a promising one where you should expect growth.
Right.
So essentially like 3 points there as well. That
if you go deeper in the semiconductor equipment demand.
Equipment, yeah, indeed. So it should be a good market for them as well. So first of all, there still seems to be demand for more advanced semiconductors, and also kind of the means and technology to make them. And that's what we saw in Taiwan. So essentially just the volume of data in the world just continues to grow, and clearly we want to utilize the data more efficiently, well, that takes a lot of energy, so we need more energy efficient chips. And well, one way to improve that was to kind of shrink the transistors on the chip surface and just cram more of them in there, but that is getting more and more difficult. But fortunately, there are other ways related to advanced packaging which allow us to improve performance and energy efficiency. So essentially stacking the chips closely on top of each other and next to each other, so that the communication between them is more efficient.
Which companies could be well positioned on that?
Disco and Besi seem to have capabilities which are essential or very useful in that path towards increasingly advanced packaging. So those I would mention as the primary ones.
Any other reasons in this?
Of the ones that are in the Sifter portfolio, obviously there are many others. But, other positive things is, well, the second is linked to protectionism, which is generally considered to be a bad thing. But, from the equipment manufacturer's point of view, it's actually good that governments are trying to create self-sufficiency in chip production. So, countries worldwide have realized that semiconductors are an essential component that you should probably produce on your own soil. Not only China has realized this, but Europe, the EU and the US are working towards that goal. And, well, that kind of race towards self-sufficiency is positive for the equipment manufacturers, because then those investments are made more with a kind of security and resiliency in mind, rather than efficiency that we shouldn't invest too much because you might have overcapacity or something like that.
So China has been the biggest investor in the recent years in the capacity expansion.
Yeah.
And now we can see that it's moving more toward US and Europe. Of course, China will continue to invest, but maybe not that much as it used to.
And probably not.
And that should benefit some of the equipment manufacturing companies.
Yes.
Right.
Yes. And well, it's hard to say exactly at what point we are at this path towards better self-sufficiency. But at least if we look at the most advanced logic chips, well, they are still manufactured in Taiwan. So at least from that sense, we are at the early stage of this this path.
Well, could you also comment on the current semi cycle and where we are standing at the moment and how the experts and the semi organization is forecasting for the future?
Yeah,
because this is maybe the third positive thing. I suppose.
It is. So if you look at the semiconductor volumes, they are actually close to a kind of cyclical bottom. They are not at the kind of cyclical heights that as you might expect if you read about the demand for AI chips. The thing with those is that they are very expensive, so they boost the industry's revenue. But if you just look at the number of chips, they are close to a cyclical bottom. And the reason there is that during the COVID and the few years after that, there was this boom for chips in general. Personal electronics sold really well. Now that kind of whether you should call it a bubble, but some kind of a strong cycle has ended. But what is expected to happen next, at least according to the Semiconductor Industry Association, SEMI, is that now the silicon wafer volumes should rebound again. And again, silicon wafers are the surfaces on which various kinds of chips are manufactured. AI chips, but also memory chips, all kinds. So indeed, the third point that kind of gives us confidence about this industry is that it's about to kind of enter a positive cyclical phase, at least when you look at the chip volumes. So,
and it's really interesting that the semiconductor companies' stock prices have been surging last year a lot, and now they came down a bit. So even though the fundamentals have been not that promising, especially in this year, so we could expect that the peak year for the semiconductor businesses will be maybe next year, 25 or even 26. So that's really interesting to see how the market will evaluate that, and does it also bring some boost for the stock prices when the big market notices that, okay, there's demand and a good performance.
Yeah. I mean, if we look at some high-level estimates, it indeed looks like the next few years should be good for semiconductor equipment manufacturers. So SEMI, for example, they predict that investments in semiconductor manufacturing equipment should grow about 10% next year, and also the investments in foundries, those should grow at about 7% annual rate over the next 3 years. And those are fairly healthy numbers, and really not too far from the earlier investments in the semiconductor industry. I mean, if you look at Bloomberg data, those investments have grown at about a 10% annual pace over the past 10 years. So, those numbers sounds like
a good numbers to us. And as you remember, one of our criteria to invest in high quality companies is that end market is growing. So we prefer companies which are dominant position in a value chain or in a sector which is growing.
Yeah.
And therefore, I would say that we are not too pessimistic regarding these four equipment manufacturing companies or the chip manufacturing companies.
Yeah.
Since there's a growth, but there's up and downs, of course.
The companies have been chosen with the idea that they hold strong positions in different points of that semiconductor manufacturing chain. So,
But of course, if the valuations go too high, we start to reduce the position in the portfolio.
Yes.
And that's what we've been doing.
Indeed. Yeah. So we identified already in the first half of this year that these semiconductor equipment manufacturers have become rather pricey relative to the earnings that we expect from them over the next 5 years, or 5 years from now, rather. We did reduce the weight of Disco in the portfolio, so we shaved that by 1/3. And then we also reduced our investments in Lam Research and Applied Materials by a bit, but Disco primarily because it was the most expensive one out of these.
Right.
Out of these 4.
Well, how would you comment? Was it a good trade-off, and what did we buy or increase in our portfolio?
We moved that amount of money from Disco to MettlerToledo, and as you can see here, so far that trade has been very, very good. So initially, it didn't really seem very profitable, but eventually Disco's valuation corrected to a lower level, and as you can see, Mettler has been a better investment over this time period. Although it's good to point out at this point that now MettlerToledo is on the expensive side within the Sifter portfolio, so we are not looking to increase our position there at this point.
Any other bigger moves we did in the springtime? What you would like to comment?
Yes. So we also sold. We sold entirely our position in Cisco Systems and Verisign. So both of those they were exposed to pretty stagnant end markets. Even though they were very strong in those markets, it just was a fairly stagnant market, and that's not something that we like. And that amount of money was then invested to TOMRA instead. And as you can see here, that has been a very good trade-off as well. So TOMRA, they are known for being a market leader in these reverse vending machines. They have about 70% market share, and there you should definitely see end markets growing because
EU regulation.
Yes, exactly. So that mandates the use of these or some recycling of plastic bottles by 2029 by about 90% rate. Yeah.
But one thing interests me, that why didn't we sell Disco or the other semiconductor equipment companies entirely if we see that the valuations are going a little bit elevated? So what is our philosophy on that?
Yes. So, we could have reduced the weight of the semiconductor companies more in Q1 and Q2. But, Sifter's philosophy, or the way we work, is to be kind of deliberate rather than kind of hasty and just, occasionally hitting the right timing. So our main focus, I feel, is ensuring that the portfolio contains a small number, but not too small number. It's like a reasonable number of companies that we know well and whose earnings we believe will grow over the long term, thanks to strong competitive advantages and exposure to growing end markets. And we adjust the weighting between those companies, but we do it cautiously and thoughtfully. So we don't try to predict changes in valuation multiples or kind of market sentiment, and we haven't really sold companies entirely just because of valuation, unless the valuation just kind of completely reaches a level where it doesn't have anything to do with the fundamentals.
Yeah. But also, if I may add, so we have learned during our 20 years track that when we sell something entirely, it's very difficult to return back and invest again. So it's much better to reduce the position and keep it smaller and then start to increase again if our confidence increases.
Yes.
That's one thing what we have learned. The other thing, what is quite interesting, is that sometimes the stock price might keep going up and up. And if we sell entirely, then we don't get the extra mile. But okay, we mitigate the risk by reducing the elevated stocks, so to say.
Yes. And in Q3, the valuations of those semiconductor companies corrected to a much more moderate level fairly quickly at the beginning of that. So during Q3, there was very little need to sell them further. On the other hand, those companies are still not quite cheap enough for them to be the most attractive buying candidates in our view, in the portfolio. So we have other companies that we look to increase our positions at the moment.
I think it was precisely 2 years ago, 2022, when the tech and semiconductor companies and stocks were quite down and depressed, so to say. And that was the time to increase those positions. Now, maybe not yet to enough low, so to say, and we like the companies what we own, and we will keep those in the portfolio. Was there any other actions in the portfolio we executed during the third quarter now?
Yeah, some small changes. So we reduced our position in Sony because PlayStation 5 game console hasn't really sold as much as we expected it to, and that kind of raises questions about Sony's ability to grow over the long term. But then we increased our position in Old Dominion and West Pharmaceutical because the weights of those companies in the portfolio were not really at the level that would reflect the fairly good risk-return profile that we saw that they offer. So, those were the main changes.
Well, let's leave the semiconductor companies and chips for a while, and let's remind ourselves and our investors that we are not a technology fund at all. If I remember correctly, that we have roughly 25% in the semi companies and a bit more than 30% in technological companies, so to say. So roughly 70% of the portfolio companies are not related into the technology or semiconductors at all. So it's good to remember that we have those high quality companies from 17 different subsectors. And in this report, of course, we have touched the ones which have been declined or made a biggest impact on the returns in this quarter. Anything to add on that?
No, not really. I mean, then we have significant weights also in industrials, which is obviously a very diverse sector. But generally, what we like is the fact that they are B2B businesses, where the logic why the customer buys the product is maybe more transparent than in some of the consumer side of the businesses, and we can be maybe more confident about that demand being there also 5 years from now. They also have a lot of recurring revenue, maybe not always in the form of service revenue, but it might be also in the form of kind of replacement revenue. I mean, they might have such significant installed bases already that occasionally products need to be replaced. Like Atlas Copco, they have made industrial compressors for over 100 years.
Yeah.
So
it's also good to remind ourselves that the current allocation, it's only the end result of our process. What kind of quality businesses we are able to identify, evaluate, and finally invest. So, which is good to us that we don't have to follow any indices. So we are agnostic on that sense. We only want to find very good businesses and which we can invest and hopefully hold for a long time.
Yeah, exactly. So due to these characteristics that I said about industrial sector, it just means that we have been able to find attractive companies there due to those characteristics, but we haven't actively decided to invest a specific amount in industrials.
Yeah.
So healthcare, another big significant sector there. So drug patents, the way that demographics impact the demand in a pretty predictable way, and oftentimes.
And margins are typically very high.
Yeah. Thanks to those entry barriers.
Right.
So. Some kind of flavor around why we have these weighings here. Kind of the reason are essentially the characteristics of those sectors. Yeah.
Do you know what is my last question to you? It concerns the stock market development. do we give any estimate how the stock market will evolve from now on?
No.
Yeah, well, that was a short and clear answer. That's not our business, and I hope that's clear for most of us now. It was really difficult to evaluate when the stock market goes down, like it did in 15th of July. Even more difficult it was to understand or estimate that it will go up 8th of August. And now S&P 500 and some of the global indices are in all-time high. Sifter Fund is not all-time high yet. We are a little bit lacking. So I think we still believe in our portfolio, the companies what we have. We have a long-term 5-year target. Of course, we hope that the stock price of the portfolio companies will go up again, but that's really difficult to evaluate. And my final note here is thank you for watching, and please remember that what the companies what we have mentioned here and let's say the principles what we apply are only for the Sifter Fund purposes. So these are not any advice to invest to any of these companies or to take any action regarding your own portfolio. Thank you for watching and see you again.